You're not going to believe what just hit the silver and copper market. President Trump just triggered a 180-day countdown that could force a new minimum price system on critical minerals. Yes, including silver and copper, using trade negotiations first and hard restrictions after. And if those talks fail, the government has a clean path to step in and reshape the price you see on your screen. That's what happened. That's the event. And in the next few minutes, you'll see why this is bigger than a headline, why the first move in price might be the smallest move, and why the real shock could land on day 179 when everyone thinks the clock is still ticking. And here's why you should stick with me to the end. The first headlines will focus on tariffs that haven't happened, while the real weapon is the minimum price mechanism hiding in plain sight. I'll break down how that mechanism can force buyers to front or run supply, why a successful deal can still raise prices, and the one signal that tells you the smart money is accumulating. Miss that signal, and you'll only show up after the move and pay the premium. Before we go deeper, quick favor. I'm running a campaign to push back on copycat channels that rip original work and repost it. If you want to support the real thing, hit subscribe and comment OG John AG below. And one more thing, if you want daily updates, quick posts, my personal takes, plus why silver and copper were named instant voice notes and fast alerts that I don't put on YouTube, I made a WhatsApp channel for this. Link is in the description. Join it because when markets move, speed matters more than opinions. Now, let's talk about what this proclamation actually means without the fluff. And the consequences can get loud, because the plan isn't only about one metal, it's about a basket. Materials that power batteries, grids, weapon systems, electronics, and the next wave of industrial competition, lithium, nickel, cobalt, rare earths, and then the two names that make the market react like someone yelled fire in a crowded room: silver and copper. Here's the twist. The first step is not tariffs. The first step is price floors negotiated with allies. Basically a coordinated minimum import price designed to stop what they call predatory pricing and to stabilize supply. It sounds polite, it sounds technical, it sounds like paperwork, but price floors are not paperwork. Price floors are power. A price floor is the demand-side cousin of a tariff. A tariff hits you with an added cost. A price floor tells you this product cannot enter below a certain price, period. And when you enforce that at scale, you're not just changing trade. You're changing the entire incentive structure for producers, refiners, and buyers. Now watch this carefully. There are no tariffs yet. That's important. No immediate, we just slap 25% on everything. Instead, they set the clock 180 days. Negotiate, align, coordinate. Then, if it fails, minimum import prices and Section 232 style restrictions are sitting right there, ready to be used. And Section 232 is not a tiny tool. It's a national security lever. It's the kind of lever that can move entire industries, which is why the market doesn't wait for day 180. The market starts gaming the ending today. Now, some of you are thinking, okay, but 180 days, why that number? And the answer is price floors. Explained. Simple breakdown. It's long enough to look reasonable, but short enough to create urgency. It fits a procurement cycle. It fits a political cycle. It fits a negotiation cycle. And most importantly, it fits a market cycle, because 6 months is the perfect window for institutions to reposition without admitting they're repositioning. Here's what that means for you. In the first month, you get headlines and confusion. In the second and third month, you get progress stories, leaked talking points, and sudden optimism that makes people relax. In months 4 and 5, you get pressure, deadlines, threats, final offers, and that's when the real buying often starts quietly because the big players don't want to be seen chasing. Then you arrive at month 6, where the public wakes up and says, wait, so what happens now? And by the time the public asks that question, the smart money has already chosen its side. So if you're still treating this like a one-day news event, you're already behind the script. Now let me explain price floors in a way anyone can understand. Think of it like this. If the government says, we will not allow imported processed silver or copper products to enter below a certain price, then the cheapest supply disappears overnight. Not because the metal vanished, but because the rules changed. And when the cheapest supply disappears, everyone competes for the next cheapest supply. And that's how floors can lift the entire curve, even without a single new buyer. But floors come with enforcement. You need reference pricing, you need documentation, you need audits, you need penalties for misreporting, you need anti-circumvention rules so companies can't relabel products and sneak them through a different category. And that's why a floor is not just a number. It's a system. And systems create winners. If you're allied, transparent, and already inside the preferred supply network, the system is a tailwind. If you're outside, the system is a wall. Now, watch how the narrative battle will play out, because this is where people get emotionally tricked. One side will say, this is protectionism, this is market distortion. The other side will say, this is national security, this is resilience. Both can be true at the same time. And while they argue the only people who consistently win are the ones who position early and manage risk. That's why I keep returning to the same idea. The point isn't to be right. The what the next 180 days could look like point is to be ready. Now, let's talk about Section 232 for a moment because people hear it and shrug. Section 232 is the legal lane that treats trade as a security issue. And when something becomes a security issue, it gains political priority. That can mean quotas, it can mean tariffs, it can mean restrictions on specific product forms, it can mean carve-outs for allies and crackdowns on everyone else. And it can arrive fast, especially if negotiations become a public embarrassment. So the countdown is also a credibility test. If leadership says, we will fix this dependence, and then does nothing, it looks weak. If leadership says, we will fix this dependence, and follows through, it looks strong. Guess which option politics usually chooses when the spotlight is bright. Now here's a fourth cliffhanger that most people won't see coming. Even if negotiations succeed, you can still end up with higher prices, because a successful negotiation can still include a minimum acceptable pricing framework. It can still include commitments to avoid dumping. It can still include coordinated stockpiling. It can still include voluntary limits that function like restrictions. So don't assume a deal equals cheap metal. A deal can be the mechanism that makes the floor legitimate. Now, let's run 3 scenarios quickly and tell me in the comments which one you think is most likely. Scenario 1, smooth agreement. Allies coordinate. Minimum pricing is quietly accepted. Supply keeps flowing, but at a higher, more stable price. Volatility cools down. Everyone pretends it was always obvious. This is the adult in the room outcome. Scenario 2, messy agreement. Talks drag. Headlines flip daily. Markets swing violently. At the last moment, a patchwork deal is announced, full of exceptions, loopholes and side conditions. Prices whip around because nobody trusts the details. This is the we avoided disaster, maybe outcome. Scenario 3, breakdown. Negotiations fail. Minimum import prices and restrictions come in. Retaliation threats hit the tape. Buyers rush to secure supply. Miners and processors become strategic assets. And the market reprices the entire complex fast. This is the shock and awe outcome. Now here's the scary part. Even if you think scenario 1 is coming, the market can still trade scenario 3 for weeks at a time just because the risk exists. So risk management matters. Now I'm going to bring this back to the ground level again. What should you literally watch for in the next 180 days? Watch for announcements about joint stockpiles. Watch for language around secure processing and trusted supply. Watch for new funding programs, loan guarantees, fast-track permits, or strategic partnerships. Watch for procurement, changes in defense and infrastructure projects. Watch for sudden shifts in export rules from other countries. And watch for the quiet signal, long-term offtake agreements, because offtake agreements are where the future gets Section 232 risk, the hard trigger priced. Now let's tie this to what you saw on the tape one more time because this is how you keep your head clear. A violent sell-off after bullish news often means one of 2 things. Either the market was overcrowded and needed to shake people out, or the market is sniffing something else like a side deal, a carve-out, or a macro risk before you see it in the headlines. So don't guess, observe. If silver and copper stabilize after the first shock, that's information. If they keep cascading without bounces, that's information. If they bounce but volume dries up, that's information. If they bounce with sustained demand, that's information. This is why I love short paragraphs. The market speaks in short bursts too. Now I'm going to say something that will save you pain. Do not treat miners like lottery tickets. If you're going to touch miner, treat it like a business analysis. Look for reserves, jurisdiction, permits, balance sheet, and the ability to finance without destroying shareholders. Because the moment policy money shows up, the best companies get stronger and the worst companies get louder. And loud doesn't pay you. Execution pays you. Now if you want, in a future video, I can break down a checklist for mining due diligence. Again, without pumping anyone, just teaching the filter. If that's useful, type miner's checklist in the comments so I know what to make next. And I'll ask one more engagement question because I'm genuinely curious. Do you think government setting price floors is a sign of strength or a sign that the free market era is ending? Tell me what you think because this is bigger than a trade story. It's a philosophy shift. All right, back to the main thread. So what did traders do? They did what traders always do when a real structural story hits a highly emotional market. They overreacted, then they fought about it. You saw volatility, you saw fast selling, you saw sharp bounces, you saw people calling the top, calling the bottom, then calling each other idiots, sometimes all in the same hour. Silver dropped hard, then got bought, then slipped again. Copper got hit, energy moved, yields wobbled, stocks did their own thing like they usually do, pretending metals are someone else's problem until they aren't. And if you're wondering why the selling can be aggressive even on bullish news, it's simple: positioning. When too many people are already leaning one way, bullish news becomes an excuse for short-term profit-taking, liquidation, and forced rebalancing. The story can be bullish while the tape is ugly, but don't get hypnotized by the first candle. The first candle is rarely the real message. The real message is what happens after the market has time to think. Because this 180-day countdown isn't just about price, it's about control. Here's what many people miss. If a government sets or enforces a price floor, it's effectively choosing the minimum revenue that foreign supply must receive to enter the domestic system. That can redirect flows. It can attract supply. It can starve competitors. And market reaction, volatility versus direction, it can pull forward production decisions that would normally take years. And then there's the part nobody likes to say out loud. If you can set a minimum price, you can also justify stockpiling. You can justify subsidizing domestic refining. You can justify building capacity. And you can justify stepping into markets temporarily until stability returns. Temporary programs have a funny habit of becoming permanent. Institutions. So if you're asking, is this bullish for silver and copper? The answer is it can be bullish in a way that doesn't look bullish at first, because in the early phase you can get chaos, you can get bargaining, you can get diplomacy headlines that sound like relief and then end up being a trap. Let me show you the trap. Imagine a deal. We'll give you access to X if you give us access to Y. Markets love that. Markets hear deal and they buy risk, they sell fear, they relax. But if the deal involves swapping strategic resources, rare earths for energy, metals for technology, supply for security, then the deal can also cap upside in some places while exploding it in others. That's why I'm telling you, don't just watch prices. Watch the structure being built behind the price. Because once a structure is in place, it changes how every dip and every rally behaves. Now, I want to pause for 2 seconds and make something clear. I'm not here to tell you to panic buy. I'm not here to scream to the moon. I'm here to map the chessboard. And the board is changing. If the government is serious about reshoring strategic supply chains, there are two unavoidable outcomes. Outcome one, higher guaranteed pricing in some parts of the chain because you need producers to invest. Outcome two, money flows toward the companies that can actually deliver real supply. Not the loudest tickers, not the best marketing, but the operations that have reserves, permits, and a path to production. And that's where the opportunity and the danger live at the same time. Because people hear silver and they think only about coins and bars, but governments hear silver and copper and they think wiring, defense electronics, grid upgrades, and industrial capacity. Different buyers, different time horizons, different pain thresholds. If you're watching from home thinking, okay, John, so what do I do with this? Stay with me, because in a minute we'll talk about what this could mean for physical metal versus miners, and why some of the biggest upside may not be in the metal itself, but in the picks and shovels. But first, one quick creative plug. If you want silver success stories from real people, there's a separate channel linked in the description. Subscribe there too. It's quick inspiration for staying disciplined when the market tries to shake you out. All right, back to the What to Watch Weekly. Until the deadline countdown. What is the government really trying to stop? They're trying to stop being held hostage by a handful of foreign choke points. Processed critical minerals are the bottleneck. It's not just do we have metal in the ground, it's can we refine it, process it, convert it into the form industry actually needs, and do it reliably. And when a probe labels that dependence a national security threat, you've crossed into a new category. This is no longer trade policy. This is strategic policy. And strategic policy doesn't ask permission from markets. It tells markets what the new game is. Now, this is where price floors become a big deal. A negotiated floor with allies does two things at once. It blocks ultra-cheap supply that undercuts domestic investment. And it gives producers confidence that if they expand, they won't be destroyed by sudden price dumping. That is the sales pitch. That's how it will be framed. But on the ground, it means the state is leaning into pricing. And when the state leans into pricing, one question becomes unavoidable. Who gets favored? Because not every producer wins under a floor. The winners are the ones who are compliant, allied, and strategically useful. And the losers, they can still sell, just not here or not at that price or not without constraints. So even before day 180, companies and countries start repositioning. Some rush to sign, some stall, some threaten retaliation, some offer side deals, some try to break the coalition. And in the middle of that chaos, the market is trying to guess one thing. Will the negotiations fail? Because if they fail, you get the heavy tools, minimum import prices, Section 232 restrictions, and potentially a broader set of actions that no one wants to spell out in a press release. That's why this is a countdown story. It's not one decision, it's a sequence. And sequences are where cliffers live. So let me give you the first cliffhanger right now. The 180 days may not be the real deadline. The real deadline is when large buyers decide they can't risk waiting. When manufacturers start whispering, we should secure supply now. When procurement teams decide it's cheaper to lock in today than to gamble on policy tomorrow, that's when stockpiling begins. Not by governments, but by the private sector trying to front or run the government. And that's when the price can move in a way the charts can't explain. Now let's talk about the market action you saw, because it wasn't random. Silver had a violent move down, then a fast buy. That usually tells you two groups are fighting. Group 1 is leveraged. They get forced out when volatility hits. Group 2 has conviction. They step in when price hits a level they consider unfair. And here's what makes this moment unique. If price floors are coming, unfair levels become easier to define because policy creates an implied backstop. Even if the floor isn't official yet, the market begins to price the possibility. That's why use silver and copper strategy. Key takeaways can see a falling knife get caught even while the headlines are still being digested. But be careful. A caught knife can still cut you because the day is not over until the day is over. And in markets, the second wave is often worse than the first. So what should you watch? Watch how price behaves around key levels after the first bounce. If price breaks below support, keeps going, and closes weak, then the structure is dominating, and you can see another leg down. But if price dips, snaps back, and holds, then you're seeing accumulation under stress. And accumulation under stress is how big moves begin. Now, I know some of you love pure chart talk and some of you hate it. So I'll keep it simple. The chart is not the story. The chart is the scoreboard. Policy is the game. And the game just changed. Now, earlier I said the opportunity may be less in metals themselves and more in miners. Let's unpack that without hype. If the government wants secure supply, it needs production. If it needs production, it needs investment. If it needs investment, it needs profitability. If it needs profitability, it needs price. That's the chain. So a price floor, even as a negotiated concept, is basically saying, we might guarantee your economics, and that can re-rate the companies that were previously ignored because capital was too expensive, or because projects were too early, or because the market didn't care.